Would giving the Federal Reserve sweeping powers to control firms that are deemed to be too big to fail be a good reform?
That would be a very bad reform. For one thing, the Federal Reserve and the other regulators missed the start of the last financial crisis by a mile, and it makes very little sense to give those same regulators the responsibility for trying to figure out how to prevent the next one. The second thing is that the proposed legislation would give this regulator, whether it's in the Fed or somewhere else, a huge amount of power over virtually any financial institution. The Fed could basically draft a company into the regulatory system. It could tell it to drop lines of business. It could even tell it to go out of business. It's a very bad idea.
I thought risky investment caused the financial system to collapse. Why wouldn't it be good for the government to create an agency to monitor risk and prevent the financial system from collapsing again in the future?
Well, it's one thing to monitor risk, but what the proposal that's out there would do is basically create a permanent TARP program. A permanent TARP program. This new TARP program would essentially allow any regulator to go out, take any firm in any situation, declare that it was a danger to the rest of the financial system, and then use billions of taxpayer dollars to bail it out. That's certainly not the approach we need. Another serious problem would be to create a super bank regulator. Some proposals would take the 4 existing bank regulatory agencies and merge them into one. In the process, they take away all the regulatory authority from the Federal Reserve and the FDIC. Now, there's a really good reason to change the bank regulatory system, since it's been pretty much the same since the Great Depression. But what this would do is take away the ability of the FDIC and the Federal Reserve to do their jobs, and that's a bad idea.
Since more bailouts or a permanent TARP program isn't the answer, how could we prevent firms from becoming too big to fail?
Well, the simplest way actually would be just to increase the capital standards that any financial institution has to have now. Capital is shareholders' equity, stock and that sort of thing, and retained earnings. And what it does is to serve as a cushion when the firm suffers losses. So if you set it up so as the firm becomes larger and becomes more risky or moves into riskier lines of business, it has to have more capital as a safety measure. That would definitely make it easier to avoid using taxpayer dollars to bail them out.